Welcome back, everyone. We're taking a deep dive today into the world of bargain hunting in the stock market.
Ah, exciting stuff.
And to help us navigate these waters, we're using Investing the Templeton Way.
The legendary Sir John Templeton.
Exactly, trying to learn from his strategies and figure out how to spot those hidden gems that everyone else seems to miss.
Well, I think his story is a great place to start. Sir John Templeton was born during the Great Depression,
In Tennessee, right?
right, Winchester, Tennessee, and it really shaped his approach to, well, everything, really, but especially to investing.
Makes sense. I mean, talk about a time of financial turmoil. So how did his upbringing influence his investment philosophy,
Well, his parents were huge on thrift, hard work.
instilling those values early on?
Oh, absolutely. But they also encouraged a lot of curiosity and independence. I mean, they actually let him experiment with electricity in their attic, like serious voltage.
Hold on, are we talking like messing around with batteries or something more intense?
10,000 volts to
Yeah.
be precise.
Wow. I guess that explains a bit about his risk tolerance later on.
Maybe, huh? But I think more importantly, it fostered this sense of exploration, learning by doing, which really carried over into his investment approach. And then, after graduating from Yale and Oxford,
Impressive pedigree.
he traveled to over 35 countries on a shoestring budget.
That's a lot of stamps in the passport.
It was. And all these experiences, I think, they gave him this really unique global perspective, which was pretty rare back then.
And that global outlook probably shaped how he saw investment opportunities, like looking beyond what everyone else was focused on.
Absolutely. He understood that a company's stock price, the number you see, it can be totally detached from its real worth. The market, it's driven by emotion, speculation.
Fear and greed, as they say.
Exactly. He saw this firsthand, even during bank runs in the Depression. Everyone's panicking, withdrawing money. And what does he do? Calmly transfers his funds to a savings account.
So he's basically saying keep a cool head when everyone else is losing theirs.
Precisely. He saw those moments of panic as opportunities, like buying a farm at an auction for pennies on the dollar because everyone else is too afraid to bid.
So being contrarian, going against the herd, interesting. But how do we know which companies are actually undervalued and which are just, well, bad investments?
That's the million-dollar question, isn't it? And that's where understanding market bubbles becomes really crucial. You look at history, whether it's the dot-com bubble or the automobile craze in the 1920s.
Those can't miss opportunities that everyone jumps on.
Right. And there are always common threads. Outrageous growth predictions, a wealth consumption effect, people spending like crazy because they think they're suddenly rich.
And of course, those unscrupulous figures who see a chance to exploit the frenzy.
Always. It's a classic case of playing the greater fool, hoping someone else will buy at an even higher price before the whole thing collapses.
And Templeton saw right through that.
He did. He believed in understanding the true value of a company, its intrinsic worth, and selling when the price went above that, regardless of the hype.
So discipline over emotion.
Absolutely. And sometimes he even went a step further into short selling.
Now, it's a whole other level of risk, right? Betting against a stock.
It is. And while he did successfully short tech stocks during the dot-com crash, he always cautioned everyday investors against it. It's not for the faint of heart.
Makes sense. It's like playing with fire, potentially.
Yeah.
But speaking of crashes, how did Templeton view those inevitable market downturns? Were they disasters to be avoided or something else?
He saw them as, and I love this quote, the best time to buy is when there's blood in the streets, even if some of it is your own.
Wow, that's pretty intense. So he's saying embrace the fear.
Not embrace it, but use it to your advantage. He stayed calm, focused on the long game. While everyone else was selling, he was looking for those undervalued gems that emerged from the wreckage.
So he's almost advocating for an offensive strategy during a crisis, not a defensive one.
Exactly. Don't just hunker down. Look for opportunities to buy low.
Fascinating. So we've talked about stocks, the emotional roller coaster of the market. But what about those seemingly boring investments like bonds? Where did those fit into Templeton's philosophy?
Well, he saw them as a powerful tool, especially in times of uncertainty. Right before the dot-com bubble burst in March of 2000, he actually recommended buying bonds.
Really? When everyone was chasing those sky-high tech stocks, that seems almost counterintuitive.
It does, but he understood how bond prices and interest rates work. They move in opposite directions. He was anticipating that the Federal Reserve would lower interest rates to combat the coming economic slowdown.
Which would push bond prices up.
Precisely. So it's about anticipating those economic shifts and positioning yourself accordingly.
Smart. So understanding the bigger picture, not just focusing on individual stocks.
Exactly. And speaking of the bigger picture, let's take a trip back in time, shall we, to the Asian financial crisis of 1997.
A real wake-up call for a lot of investors. Excessive leverage, currency speculation, it all came crashing down.
It did. But in classic Templeton fashion, he saw opportunity amidst the chaos. He invested heavily in South Korea during the crisis.
Interesting. Most people were running for the exits, but he saw potential there.
He did. He had confidence in the country's long-term potential. He saw parallels between South Korea's rapid industrialization and, well, another country he was very interested in, China.
Ah, China. That's a whole other conversation, and maybe one we can get into a little later. But first, tell me more about what drew Templeton to South Korea.
He saw a nation with a high savings rate, an export-driven economy hungry for growth. He was impressed by their work ethic, their focus on technological advancement. He really believed they could bounce back.
So he was looking beyond the immediate crisis to the underlying fundamentals.
Always. He understood that sometimes the best bargains are found in the most unexpected places. And it's not just countries, you know. His approach applied to sectors, too, even those that seemed, well, pretty risky. Like during World War II, he got into penny stocks.
Penny stocks
Mm-hmm.
during a global war. And that sounds like not the safest bet.
Most people thought so. They were running for cover, but he saw an opportunity. In 1939, he borrowed money to buy 104 stocks, all priced under $1.
Hold on. He borrowed money to invest in essentially struggling companies during a war. That's a bold move.
He had a theory. He believed that wartime economy would eventually lift the market, and he wasn't afraid to act on his convictions.
And did it work?
It did. Within 4 years, he quadrupled his initial investment.
Wow. Okay, that's impressive. But what made him so successful in that particular scenario? Was it just luck, or was there something more?
Well, luck always plays a role, but he did his research. He focused on companies like, Missouri Pacific Railroad, for example. They were on the verge of bankruptcy, but he saw how they could benefit from the increased shipping demands of the war effort.
So he was able to look past the immediate crisis and see the potential down the road.
Exactly. He wasn't swayed by the market's short-term anxieties. He was focused on the underlying value.
And his wartime investments, they also highlight the importance of diversification, right? Spreading the risk.
Absolutely. Don't put all your eggs in one basket, as they say. Even if some of his ventures failed, others flourished. It balanced things out.
So not just picking the right stocks, but managing risk wisely.
Exactly. And, his approach to investing, it wasn't just about stocks and bonds. It was a whole philosophy, a way of life. He believed in finding value in everything.
Like a bargain hunter at heart in all aspects of life.
Precisely. Whether he was negotiating a deal on a car or finding treasures in antique shops, it was about frugality, being resourceful, recognizing those overlooked opportunities. Speaking of which, we have to talk about his discovery of the Japanese stock market back in the 1950s.
Ah, Japan. This was post-World War II, right? A country still recovering. Most investors probably saw it as too risky.
They did. It was considered an untested market, but Templeton, he saw something different. He recognized Japan's potential for growth.
What specifically drew him to Japan? I mean, it was a pretty devastated country at the time.
A few things. He saw their high savings rate, which he knew would fuel investment and economic expansion. And he was really impressed by the Japanese work ethic, their drive for technological advancement.
So it wasn't just about the numbers. It was about understanding the culture, the people.
He believed that understanding a country's cultural values was just as important as analyzing its financial statements. In Japan, he saw a nation determined to rebuild, to become a global force again, and his instincts were spot on.
And Japan's economy did boom in the decades that followed. They became a major player on the world stage.
Exactly. And his early investments in companies like Toyota and Sony paid off big time. It really showed his knack for seeing the long game, for being a contrarian.
But his success in Japan, it wasn't just about picking the right stocks. He understood the market itself, how it worked.
Right. He realized that the Japanese stock market at that time was pretty inefficient, meaning stock prices often didn't reflect their true value.
So more opportunities for someone like Templeton who could spot those discrepancies.
Exactly. He understood that information asymmetry, knowing something that others didn't, that was a key to his success. He had a talent for spotting these accounting inconsistencies that mask a company's true earning potential.
So he wasn't just looking at the surface numbers, he was digging deeper.
Always. A good example is his analysis of Hitachi. He discovered that their reported earnings didn't fully capture the profits being generated by their subsidiaries.
He found hidden profits within the company structure. That's incredible.
It allowed him to buy Hitachi stock at a discount because other investors, they weren't seeing the full picture.
So understanding those accounting intricacies, seeing the true value of the business, that's really impressive.
It all comes back to that due diligence, that willingness to go beyond the surface. And that's something he applied to all his investments, not just in Japan. He was a true global investor, always looking for opportunities beyond his own backyard.
He believed in casting a wide net, exploring different markets.
He said limiting yourself to one market was like shopping at only one store. He wanted to explore the entire marketplace of investment opportunities. He was especially interested in emerging markets, places with high growth potential.
Makes sense. More room for those inefficiencies, those hidden gems that he was so good at finding.
Precisely. And his global perspective, I think it's even more relevant today. Emerging markets are playing an increasingly important role in the global economy.
So exploring new horizons, being open to different possibilities, that's a valuable lesson from Templeton. But what about when those horizons get a little stormy, when the markets are in turmoil? How did he handle those situations?
He believed that market downturns, while scary, they also presented unique opportunities, particularly for those with a long-term perspective. He saw them as a time to buy, not sell.
Buying when everyone else is selling. That takes guts.
It does. He had this famous saying, the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. He saw market crashes as a chance to acquire quality assets at bargain prices.
Essentially, capitalizing on other people's fear. That's a bold approach, but it clearly worked for him.
It did, and it shows the importance of staying disciplined, of not letting your emotions dictate your actions, especially when things get rough.
It's easy to get caught up in the frenzy, whether it's a bull market or a bear market.
Exactly. But keeping a level head, sticking to your investment principles, that's key for long-term success. Now, before we wrap things up, I do want to touch on a topic that might seem a little, well, less exciting than stocks, but it's a crucial part of building a solid portfolio. Bonds.
Okay, let's talk bonds. They're often considered the safe part of a portfolio, right?
They are, generally speaking. Stocks, they have the potential for higher returns, but they also come with more volatility. Bonds tend to be more stable, they provide a steady income stream, and they can act as a ballast during those turbulent market conditions.
So a bit of a counterbalance to the ups and downs of the stock market. But how did Templeton approach bonds? Did he see them as purely defensive investments, or was there a more strategic element to it?
He definitely saw their strategic value, especially during times of uncertainty. Remember how we talked about him recommending bonds in March of 2000, right before the dot-com bubble burst?
Right. It seemed counterintuitive at the time.
It was a brilliant move. He understood the relationship between bond prices and interest rates, how they move in opposite directions. He anticipated that the Fed would lower interest rates to try and stimulate the economy after the bubble burst.
And that would push bond prices up.
Precisely. So it was about anticipating those economic shifts, understanding how different asset classes would respond.
That's fascinating. It shows a real depth of understanding about the macroeconomic landscape, not just individual companies.
And it brings us to another important takeaway from Templeton. It's not just about finding bargains, but understanding the bigger picture, the forces that drive the markets.
And speaking of bigger picture, Templeton wasn't just focused on making money. He was also deeply committed to giving back, to philanthropy.
Absolutely. He believed that wealth came with a responsibility. He established the John Templeton Foundation. It supports research and scholarship in a wide range of areas.
From science and religion to human character and purpose. Quite a broad scope.
It reflects his own intellectual curiosity, his belief in the power of human potential.
And his foundation has funded some really groundbreaking work over the years. It's an inspiring example of using wealth to make a positive impact on the world.
It certainly is. And it reminds us that success isn't just about financial gain, it's about making a difference. Looking back at Templeton's journey, from his childhood to his global investments, his philanthropy, I think it all points to some key takeaways.
Right. We've covered a lot of ground. It would be great to distill it all down to some core principles, some things that listeners can take away and apply to their own lives. Maybe even create a top 10 list.
A top 10. I like it. Okay, let's see if we can summarize the wisdom of Sir John Templeton. All right, so our top 10 takeaways from Sir John Templeton, the bargain hunter extraordinaire. Number one, and this is crucial, separate the stock price from the intrinsic value.
Right, the market can get swept up in emotion, but our decisions should be based on logic and analysis.
Exactly. Number two, think globally. Don't limit yourself to your home market. Explore opportunities around the world.
Expand those horizons, look for those hidden gems in different corners of the globe.
Number three, be wary of those market bubbles. Learn to recognize those signs of irrational exuberance. Don't get caught up in the hype.
Easy to get swept up in those can't-miss opportunities, but they often end up missing.
Number four, view crises as opportunities. When everyone else is panicking, that's when the real bargains emerge.
Requires courage, going against the grain, but as Templeton showed, it can pay off.
Number five, bonds. Those seemingly boring investments, well, they can be pretty powerful, especially in uncertain times.
Providing stability, a bit of a safe haven when the market gets choppy.
Number six, learn from history. Recognize those repeating patterns in markets and economies. It can give you an edge.
Like having a roadmap, helping you anticipate what might be coming next.
Number seven, always do your due diligence. Thoroughly research every investment, know the fundamentals, understand the potential risks.
Knowledge is power, as they say, especially when it comes to investing.
Number eight, patience. Bargain hunting is a long-term game. Don't expect to get rich quick.
Slow and steady wins the race. Resisting that urge for instant gratification, that's key.
Number nine, stay calm, stay rational. Avoid making emotional decisions, especially when the market is volatile.
Emotions can lead to impulsive moves, and that rarely ends well in the investing world. Discipline over fear and greed.
And finally, number 10, and maybe this should be number one, remember that investing is about more than just making money. It's about aligning your finances with your values.
Like Templeton's commitment to philanthropy, using his wealth to make a positive impact.
Exactly. It's about finding that balance between financial success and contributing to something larger than yourself.
Well, I think those 10 points really encapsulate the essence of Templeton's approach, his wisdom. It's not just about picking stocks, it's about having a philosophy, a mindset.
And a willingness to go against the crowd, to think differently.
This has been an incredible journey exploring the mind of Sir John Templeton, a true investing legend.
I completely agree. And for anyone who wants to delve even deeper into his ideas, Investing the Templeton Way is a must-read.
Absolutely. His principles are just as relevant today as they were decades ago. So until next time, folks, keep exploring, stay curious, and happy bargain hunting.